Hello and welcome to the latest in our quarterly webinar series, A Unified View of SME Credit Risk from Dun & Bradstreet. So this is a pre-recorded webinar today, should take roughly 15 to 20 minutes, and we're looking at economic insights and business payment trends from the UK. So my name is Stephen O'Toole, I'm a Senior Marketing Manager here at D&B, and I've got two of my colleagues with me today. I've got Grant Hickson, who's a Senior Economist in the Country Insights team, and Ravi Sidhu, who's a credit risk SME. So Grant, if I could hand over to you to kick us off with the economic insights through an SME lens.
Thank you, Stephen. There's been a lot happening in the UK in the past 18 months, and also fair to say around the world, particularly around politics, policy making and economics. We've had a general election, some uncertainty around government priorities, then the autumn budget. Abroad, there's been growing political challenges in Europe and the new administration in the US with the uncertainties that this is presenting. Then there are the ongoing global geopolitical disruptions and conflicts. And to some extent, the UK has entered 2025 at something of a crossroads. In common with many other economies, the UK faces a delicate balancing act of supporting growth alongside domestic and overseas headwinds, of announcing policies that address challenges in the UK, but are also mindful of uncertainties beyond the borders. And put together, it's a lot to think about and to develop a clear sense of direction. And even if we just look at the UK, it's difficult to look across all the data and separate the signal from the noise into something meaningful. Business confidence seems to have taken a battering, and looking ahead, it's not entirely clear where companies might see respite. A significant rise in national insurance contributions for employers comes into effect early April this year, but this has already dampened hiring intentions and forced firms already struggling with rising operating costs to consider how they're going to deal with these additional costs. The chart on the next slide plots wages, inflation and interest rates. The first thing to highlight is the signs of inflationary pressures, which is the grey line. They seem to be returning, even with businesses cutting jobs at the fastest rate in 4 years, actually since 2009, if you look past the pandemic effects. Prices are rising faster than the Bank of England target of 2%. In December, inflation came in at 2.5%. In January, it was 3%. And we like to see inflation move up higher still when policies such as the national living wage and the insurance contributions hike come in April. I think the Bank of England expects inflation to reach somewhere near 4% this year, but the recent tick up in inflation perhaps means that the central bank would prefer to act cautiously before loosening policy. And so that implies fewer interest rate cuts than may have been the case had inflation continued to moderate in a more linear fashion. So perhaps not much support from interest rates then. On the next slide, this looks at the impact of inflation in a bit more detail. The chart shows inflation in level terms rather than the annual change in prices, which is the most reported measure, because the annual comparison is important to compare what you're paying today versus what you paid for the same things last year. And as I mentioned earlier, the annual inflation rate has fallen to more historical norms, around 2 to 3%, and certainly much lower than the 10% price rises during the height of the cost of living crisis. But if we look at how prices have changed compared to, say, 4 years ago, we can get a sense of why the cost of living crisis is being so acutely felt still. The two horizontal blue bars show the price level in January 2021 and the price level in January 2025. And it shows the price change during those 4 years of around 24%. If we were to do the same exercise in the 4-year period prior to the pandemic, prices increased, but by just 10%. So this gives a good sense of why consumers and households are still feeling the pinch. Even though inflation in annual terms is slowing, people and businesses are having to adjust to a huge and sudden ramp up in prices, which would normally have occurred over a much longer time frame. And businesses are having to deal with this squeeze on consumer spending. People are buying less or less frequently, they're scaling back, deferring from discretionary spending. Plus there's other things like higher energy costs, the increased cost of transportation and shipping. And no doubt there are some SMEs that are just unable to work out how the change in wages and tax will affect their companies. They may know that higher costs are on the way, and they're waiting to see how they might be affected both directly and indirectly. Move on to the next slide, please. So one way to deal with these additional costs is to seek lending. And this chart shows outstanding lending to SMEs, which is the lighter coloured grey line, and to larger businesses, the darker blue line. The latest data show that the value of outstanding loans to UK SMEs has continued to fall through the back end of last year, perhaps signs it might be levelling off. Political uncertainty and the pivoting of monetary policy at the Bank of England will have created some hesitation about future lending. Broadly, banks have tightened borrowing conditions and reined in lending to SMEs as interest rates began to increase. So as interest rates are lowered, we may see a relaxation of lending requirements and so more lending. The economic outlook is crucial for lending. We're expecting the economy to grow about as much as it did last year, though we've recently downgraded our short-term outlook because of softer than expected indicators. And we're expecting interest rates to be lowered at least a couple of times this year, though there's an unusually large degree of uncertainty around that. And that should feed through into lower financing costs, notwithstanding lenders and borrowers alike will remain cautious. It's encouraging, though, I think, and I've highlighted that here, that according to a recent ONS survey, almost 3/4 of SMEs have a moderate to high confidence of meeting debt obligations, which is up from 2/3 from around the middle of last year. We're not showing the data here, but if you look at effective interest rates for SMEs on new loans, both fixed and floating, they've risen sharply over the past few years, plateauing in about Q2 2023 at around 7.5%, and they haven't really come off since then. They're about 6.9% now, compared to about 3.5% pre-pandemic. So some of those high rates are effectively product rates running off still high benchmark base rates. And the base rates have been kept high because of government bond yields rising in line with the US, but also market doubts around adherence to fiscal sustainability rules. And related to that specific point, the spring statement will offer some sense of how the government considers or understands the market reaction to the autumn budget, and also crucially how it will respond given the rising gilt yields. We can move on to the next slide, please. So high interest rates likely mean increased debt servicing costs for SMEs. And what we saw on the previous slide, that there's been an increase in perceived ability to meet those obligations. For some more vulnerable businesses, those costs put them under pressure to remain viable. Using our data here at Dun & Bradstreet, we track business closures in the UK by sector, and we now have data for the full year of 2024. And last year, business failures actually fell to around 24,000 from 24,700 in 2023. So this represents a small slowdown, about 2.5%. But the number of failures is still relatively high compared to around 14 to 15,000 a year pre-COVID. In 2024, most business failures were in business services, around 5,000. So it works out about 1 in 5. Construction, about 3,500. Restaurants, about the same. But there were 10% fewer restaurants that went bust in 2024 than 2023. Looking ahead to this year, I think we might see a further slowdown in the rate of bankruptcies in annual terms. But I think we're probably likely to see a continued elevated quarterly numbers this year. And a lot of the uncertainty that I talked about, particularly domestic sources of uncertainty, such as the election, are now behind us. So we have relative stability in that sense, which is positive. But has some uncertainty that has been cleared been replaced with uncertainty elsewhere? I think the answer is to a degree. And to a degree, this reflects actually the ongoing nature of business, adapting to ambiguous trading environments, unclear and changing government policies and regulation. It's just that it's particularly high at the moment. So where do we go here, on this chart? I mentioned before, we're not expecting the economy to push on in growth terms much more than it did last year. And there's something of a relationship between activity in the economy and the rate of businesses going under. In fact, if we look at the overall business optimism headline index for the UK, the latest reading for the Q1 2025 GBOI shows a deterioration in overall business confidence and an entire reversal of the optimism seen in Q4. But I think that largely reflects the fairly negative view of the domestic economy that I've sketched out today. And I think actually we might perhaps see something more of a more positive outlook in the next survey. We might see signs of businesses looking to deal with a softer economy at home, with the challenges around prices in the UK, mitigating the impact of potentially higher tariffs in global trading environments, by exporting to alternative markets or possibly relocating production, and even by raising prices to offset some of those increased costs. We may also have to wait until after the spring statement for some of that pessimism to be reversed. On the next slide, please. When Ravi and I talked about this presentation, we discussed the current UK macro environment, how difficult it is to make sense of things or to get direction at the moment. And what I think comes across when you look across the UK macro data, it's difficult to interpret at the moment. The signal isn't clear, there's a lot of noise. And the challenges at the moment in the UK include inflation fluctuations, interest rate uncertainty, trade adjustments, global supply chain disruptions, mixed confidence reports. And this book by Nate Silver, The Signal and the Noise, explores how to distinguish meaningful patterns, so signals, from misleading or conflicting sources, and that's the noise. And the point I've hopefully illustrated at the start here is how businesses should be cautious because of all the data that taken together is difficult to detangle, and instead make adaptive, data-driven decisions, distinguishing between the noise and high-quality signals. And I'll hand over to Ravi here to talk more about those high-quality signals.
Thanks, Grant. And just to reiterate, the ability to predict outcomes is notoriously difficult, and that includes the economy. The economy is incredibly complex with multiple factors, and while Grant's done a great job of outlining the key indicators in terms of direction of travel so far, how that translates to how you need to work is still a little unclear in your day-to-day business. And just to kind of focus in on one of the key kind of phrases or points within the book that Nate Silver highlights is distinguishing the signal from the noise requires both scientific knowledge and self-knowledge, the serenity to accept the things we cannot predict, the courage to predict the things we can, and the wisdom to know the difference. And I'm aware that's a play on other phrases that you may have heard, but it still is very insightful in terms of the challenges that we face today. So what I'm going to share over the next few slides is the alternative data sets, which will be more relevant to the outcomes you're looking to predict and the actions you may need to take as a result. My hope is that you will see additional insight as relevant, providing a better signal and hopefully not creating too much noise. So if we move straight into the first slide. Dun & Bradstreet has one of the largest global commercial trade data networks with over 15,000 partners and 700 sectors that it covers. It's twice as large as the closest comparable data set. And for the UK, when observing missed payments of 90 days or more across this data set, we see divergence in payment performance between SMEs and corporates. SMEs have actually fallen back in line to pre-COVID levels in terms of payments. But it looks like corporates may be choosing to pay more slowly due to their increased pressures. Unfortunately, SMEs, which is shown with the orange line there, don't have that luxury and probably are more invested in maintaining good credit relations. But as we know, SMEs will still be a higher risk when it comes to business failure risk. So what do we see when we look at sectors? If we look at the next chart, when we look at payment performance across the 5 largest sectors within the trade file, you can see that there's pressures that have been felt over the COVID period, over the last 5 years. Accommodation and food have felt the most significant pain. And in the main, most industries are coming back in line with pre-COVID levels. However, professional and scientific services still remain slightly higher, and manufacturing has actually been bucking that trend slightly. It's actually been gradually increasing, and that's probably attributed to rising costs, which will be increasing pressure within those sectors. It's important to remember that this is the performance of businesses with trade credit terms, but not every business may have a footprint or a significant one in this space. So there are limitations when using this data. So the question is, other than financials or trade credit payments, what other signals could we use? So if we move to the next slide. here is where we can start looking at other data sets. So as it happens, there is a data set available referred to as CCDS, and it's the short name for the Commercial Credit Data Sharing Scheme, which holds information from financial institutions on SMEs with turnovers of less than 25 million. Now that sounds like a restriction, but ultimately that covers 99% of the market. Products such as loans, cards, and current accounts are all included. So for illustration, in terms of what we are seeing in mortgage lending, the long-term trend has overall been trending down, with missed payments, so that's 3+ delinquency, gradually trending upwards. Now, recently, there has been some movement in interest rates, but it is clear it will take time for these factors to feed through to SMEs and their confidence in terms of lending. And while there are some encouraging signs in the most recent data points, it would be good to see what the next quarter of results show. There are some further insights that we can see on the following slides. Now, one of the key differentiators of the CCDS scheme compared to previous voluntary arrangements is its coverage of current accounts. And that's not just the insight on payment performance on overdrafts, so whether they've missed payments or not. It's much more than that. You have visibility of detailed data on inflows, outflows, bounce payments, and a host of other activity, which is extremely useful when understanding the recent cash flow of a business. For illustration, this insightful data set shows the trend of current account turnovers improving post the COVID period. And you can see on the top chart, it's leveling off more recently. Now, on closer inspection, the net turnover, which is the difference between the credit and debit turnovers, has actually been negative over the last 18 to 24 months. On average, this net shortfall of 500 is of £500. But no, this is just an average. There will be SMEs that will be experiencing more pain and others that may well be thriving at the extremes of. If we move on to the next slide, what we see is some further insight here. Now, up until now, we've been talking about the data, but what does that really mean? As much as it's interesting, what value can we see from the data? Now, as a designated CRA, we've developed scores to predict the likelihood of non-payment on various credit facilities. And as the first chart clearly shows, accommodation and food still remains a standout high-risk area. But what's more insightful is looking at the chart below. So in the chart below with the green bars, it's showing there's improvement on manufacturing, construction, and professional services. Now, some of these signals may be inconsistent, in particular around manufacturing, when we compare it to the trade payments, but that underlines a key point. It's really important to have a view across a range of relevant data points before lending and identify what is the noise and what is the signal. And the truth is, you can only do that with a data-driven approach. Moving on to the final slide. It's a problem that we're looking to solve, and we've been looking to solve across for lenders, business lenders, and trade credit providers. So at this point, we'd like to introduce the unified risk view. So whether you're looking to maximize efficiency and profitability, protect your business from financial risk with predictive intelligence, or looking for data in a one-stop shop to make these consistent assessments, D&B can assist with any of the outcomes your business is ultimately looking to achieve and help you navigate in what is a very challenging market. And on that note, I'll hand back to Stephen.
Thank you, Ravi, and thank you, Grant. Great job as always, and brilliant insights for our audience. So I think that concludes today's webinar. Thank you for your time. As Ravi said, please do search for the D&B Unified Risk View to find out more about this new solution, or you can follow the call to actions at the end of this video. Thank you for your time today, and we'll see you on the next recording in Q2.